All right. Hi, everyone. Barry McGuire here. It's not 5 o'clock. It's 5:30 Mountain Time. A little change in schedule. Here we are, Barry McGuire's Creative Real Estate Education Series. All things real estate, all things investor. We've done a lot of things on the program, and today I'm really pleased to have Stuart and Denise MacPherson show up. Going to just chat a little bit about them, then we're going to bring them in. We're going to hear from Stuart and Denise where they started and how long they've been at this. But Donna and I have known Stuart and Denise for a long time now. We met them when we would be out in Ontario doing RAIN events with the Real Estate Investment Network. They're longtime RAIN members, longtime investors. They're living in Ottawa, and tonight they're going to talk to us all about what they call RRSP mortgages and lending. And that, of course, means anything that is a loan from a registered plan. We call them RRSP loans because that's kind of the most common place for people to have their money, but it also covers things like LIRAs and RIFs and TFSAs, tax-free savings accounts, anything that is a registered plan run by the federal government, but we always refer to them as RRSP mortgages. So that's going to be tonight's topic. We're going to dig into the good, the bad, and the ugly of RRSPs. We're going to start with the very basics, because there's a lot of folks in our group, and Donna and I regretfully don't know everybody personally, so we don't know everyone's experience level. We don't know if you're just maybe hearing about RRSP mortgages for the first time and that you might be able to do a loan if you have an RRSP, or whether you're an expert, and all levels in between. So we're going to do some basic introducing of what this thing called the RRSP mortgage or RRSP loan is, and why you would want to do it, where you would use it, why it's better than other forms of investing, how it fits into particularly into the real estate investing world, and all points in between. And of course, there'll be lots of time for questions. You pop your questions into the chat. Focus team will be answering those as we go along. Wayne will pop them up for Denise and Stuart and I to look at various points during our time together tonight. We'll try and get all your questions answered and really shine light on this thing called RRSP mortgages. So with no further ado, we're going to bring in Stuart and Denise and get to know them a little bit. And golly, there they are, just like we know what we're doing here. Hi, you guys. How's it going?
Technology is wonderful. It's nice to be on with you.
Yes, thank you so much for the invite. That's wonderful.
Oh, that's good. And we do go back, a long time to Ontario RAIN meetings. And so for folks who don't know you, and I probably think lots of people do, but give us your background. What did you do during your lives before you were investors? What was your day job, and what shone the light on doing something different with your investing so that you got started in what you're doing now? I always like to hear people's backstory because it kind of helps know why we're at today. Denise, why don't you start? What did you do for your day job?
Well, I started off my career teaching. Actually, is where I started. And even throughout my life, I ended up getting into some education portion of it throughout that. But I taught, then I was a stay-at-home mom for a while, and I started a business. I've also been a professional makeup artist that people go, what? Yes, I was a professional makeup artist and a image consultant for over 25 years. I did that, and some of it was full-time for a while, but then I went back to work, and I actually worked for the government. And I spent 20 years with government, moving up in the organization. Both Stuart and I, actually, that's where we met later, is at work. But I started off with border services, and I started off as a customs inspector at the border. Yeah, I did that. And this was way before the guns and everything else. But what I loved was actually the commercial portion of it. So dealing with importations and exportations in and out of Canada. And then just won competitions and ended up my career after 20 years as the strategic advisor to the VP. So I handled a lot of the problems, let's say, just at a higher level with government is what I ended up doing. And then I retired from government January 29th, 2010. Which at that point, and Stuart will probably mention a little bit that at this point we're together and we decided that we wanted more from, let's say, more for our future because we both went through a divorce into the 1990s. And anybody who's gone through a divorce, you know that it plays havoc with your finances. And not that I want to make this a sob story because that's not what it is, but I mean, I went through spells early on through my divorce where I had 52 cents to my name, you know, until the next payday. So, I mean, you go through, I mean, divorce is hard on everybody. So when we got together and we're putting two households together, well, he went through a divorce too. So needless to say, maybe I'll get you to kind of fill in that gap, Stuart.
I mean, living here in Ottawa, you almost expect that everybody works for the federal government. And so I had done 31 years as well. When Denise and I got together, we were both looking for something different. I was still happy in my government job, but Denise was starting to feel the pinch, getting tired of the day-to-day grind of working as a federal government employee. So we started to look around to see what other things we could do. The side hustle, as the millennials like to call it. And we tried some things. We did some multi-level marketing for a while. We looked at other business opportunities. And it's actually funny, when Denise and I first put our households together, she had a condo.
Yes.
And she said to me, why don't we keep it and rent it out? And my immediate reaction is, are you nuts? Who wants to deal with tenants at 3 a.m. calls about plugged toilets? So it was probably about 10 years later that I started to relax and I saw the light and we started to take some training. And we got involved with investing in real estate. And that brought us forward to where we are today. But the interesting thing was that when Denise left government, one of the things that they used to do in those days was they paid severance pay. And they made the offer of her 20 years worth of severance pay to either take it as cash in a nice check or to have it deposited into our RRSP. Well, this would have been 2010. And those of us who've been around for a while will remember that in the early 2000s, there was the dot-com bust that did a real job on the stock market, did a real job on a lot of mutual funds. Then in 2008, 2009, there was the worldwide financial crisis, and that did a job on the stock market, which meant we lost megabucks in our mutual funds. And mutual funds were the last things we wanted to invest in, but at the time, that's all we knew about using registered funds for, was putting them into mutual funds.
And then we tried the stock market without any education. Guess what happened there? So we actually started, when I was about to retire, we made a decision that, hey, let's do real estate. And the thing is, we were looking at putting our lives together. Like I said, divorce creates havoc. And you wanted to do something to have a better retirement for ourselves. So we looked at real estate. We started educating ourselves in 2009 in readiness for when I'd retire. So that was the plan there. And through one of the courses is where I happened to be standing talking to people and I heard the words RSP mortgage. And I turned around and I said, who said that? And they go, who said what? Nobody else heard it except me. And it was enough to put a bug in my ear that I started investigating. And then with the fact that I retired, I actually did put in RSP, which is not what my plan was initially, but I thought I got to try this RSP mortgage thing. And I went back to a class and there were 8 investors there. And I said, I got this many thousands of dollars for an RSP mortgage. Who would like it? Everybody said, pick me, pick me. And I'm going, wow, this is amazing. And so when we did our very first one, we didn't know what we were doing. But let's just say that was the very first one. Now we're talking back 11 years later. Things are different now.
Yes. The interesting thing there is you went to your group of investors and said, I have RSP money, do RSP mortgage, who wants it? And everybody put up their hand. So the thing of it is, and we have to get into a bit more detail for folks. If you have money, people are interested in you. So let's just get into the very basics. So
Sure.
there you were retiring from government. You might have put your severance into your RRSP, or you maybe already had some RRSP money. Anyway, you have money in your RRSP, and you discovered through research that you could actually lend that money to other people. So
the interesting thing is that in my 31-year career in the federal government, I have to admit, and I do this very, very humbly and very quietly, 5 of those years were with the income tax department. And so I understood how to take a look at the CRA's website in order to figure out what the rules were around our RRSPs. And something the banks won't tell you is that you can put your registered funds, whether it's RRSPs or TFSAs, into lots more than just the bank's mutual funds. But the reason why the banks won't tell you that is they don't make any profit if you put your RRSPs in something like gold, or something like directly into the stock market, or into mortgages on Canadian property. But it's all legal. It's there on the CRA website.
Yeah.
Now, the one thing is that there are some rules that go with that. But the rules are not that difficult, really. I mean, the big thing is that if you've got money, and we had some money and we were unhappy with the returns we were getting, so we decided to try mortgages. It gets used the same way private lending does, as a private mortgage. So, of course, all of the lending is done and documented by a mortgage that is registered with a lawyer.
Like Barry.
On title. And basically, the terms of the mortgage, because it is a private loan, are strictly negotiable between the borrower and the lender. Now, a couple of things to keep in mind. The money in your RRSP has to be with a trustee that allows mortgages. The banks are trustees, but they don't allow mortgages because that cuts in on their business. They have no interest.
Arm's length mortgages. Yeah.
And the trustees have some rules themselves because they've got to report to Canada Revenue Agency and they've got to go through their own annual audits. So we tend to like putting our money with Olympia Trust out of Calgary. We found that they're the easiest to work with. They've been very good to us. We've been with them ever since we started. They have a rule that there has to be at least one interest payment per year at market rate. So what that means is that as an investor looking to borrow funds, I don't have to worry about what the bank is going to want, which is a monthly payment of principal and interest, particularly if I'm using this money while we're doing a renovation, for example, and there's no revenue coming in. So the nice thing about it is that there's lots of opportunities. It's very flexible.
Okay, well, let's stop there for a second. Got a bit of an echo here. What's going on there, Donna? So you have to have your money with a trustee. There are, as you point out, there are lots and lots of trustees. There used to be lots and lots of trustees in the RRSP space, but gradually they've all exited to the point where there are very few trustees. Here, just a second here. My tech is helping me out. Thank you, techie. Oh, that's much better.
There we are.
Good.
Okay, yes, I can hear fine. All right. Well, there used to be lots of trustees. Now, Olympia has really taken over that space, and I think they're only based in Calgary. So there is Olympia. I know Canadian Western Trust, which is another Western-based trust company, also are in this space, and there might be a few others.
B2B.
But overall, B2B, I think, does as well.
And there's Community Trust in Toronto.
Right.
Those are the 4 big ones across Canada.
So that's Olympia,
Canadian Western Trust, B2B, and community trust.
Okay. So B2B and community, perhaps more in Ontario and places east of Alberta.
But even at that, you know what? The one thing we find, Barry, though, is Olympia Trust still seems to be one of the trustees of choice. Doesn't matter where you are.
Yeah. I would say that probably 19 out of 20 RRSP mortgages that I do are with Olympia. Mm-hmm. And the reason is that they put some time and effort into our RRSP, into being an RRSP trustee. They've got a really good program. They know what they're doing. They have specialists there. They're very helpful. Dealing with most other entities is much tougher. I had one with Canadian Western Trust last week, and they completely changed policies since the last time we did one with them. The person I was dealing with didn't seem to know. So overall, folks, not to beat this up too much, we recommend Olympia. And so just to be clear, if you want to lend money, you have to have an account set up at Olympia Trust, who are out of Calgary. They've got a great website. And so if you have stocks or mutual funds or other investments in other places, you have to get them over to Olympia. You have to turn them into cash. And then you have to get that cash into your Olympia account. And once it's in the Olympia account, then you can lend. And
one of the big thing, and this is something when we talk to people, because we walk them through step by step. If you leave them on their own, it looks too complicated. And when there's a confused mind, you do nothing. So whenever we have an investor that we talk with, or when I say not just necessarily a real estate investor, but anybody who has funds to invest, we walk them through step by step. We'll even call Olympia Trust with them. I know what the newbie questions are. When they are a newbie, they're not quite sure what to ask. So by having them on the line with Olympia Trust, it just gives them that confidence, because I'm not Olympia Trust, but it gives them the confidence that as I ask questions, they go, oh, and then they may ask a question or two, and then they feel better about what they're doing. But that becomes super important.
Now, the one thing that I also want to mention, Barry, is that when we're talking to people about how to move their funds from their current trustee to Olympia, one of the things that we stress is you've got to have it all in cash, but it has to stay within the RRSP umbrella. Mm-hmm. Because if you go to your insurance company or you go to your bank and say, I want you to sell all of my mutual funds, they might think that you actually want the cash in your hand, which means that you're going to be paying income tax on everything.
Right.
So it has to stay within the RRSP umbrella, and it gets transferred from your institution directly to Olympia Trust. And Olympia Trust, once you fill out the paperwork, they handle all of that.
And the thing is, you never touch the money. You let the financial institutions do the transfer and all of that. So at no point do you touch that money at all.
Now, the other fun thing we warn people about, when you go to your bank or your insurance company and tell them that you're planning to transfer your money to somebody else, you wouldn't believe what they're going to tell you.
Oh, yeah. I mean, it's funny that he mentions that, because what personally happened with me when I went to see my financial planner and I said, listen, I've learned about RSP mortgages. This is what I want to do, because I knew what I had been losing. And I had been with him. Well, look at it this way. I'm in my 60s and I've been putting in RSPs in since I started my work career many moons ago. And you know what it's like. They tell you, I was even reading something yesterday, put it in there, like put it in mutual funds or put it in stock. And if you can get a 10% return, just think of the money you're going to have where you're going to retire. You ask the people today that are of retirement age or about to retire, have they seen those types of returns year after year after year? Absolutely not. We've seen negative returns. We've seen 0.00 of 1%, you know, like it's been crazy. So when I asked my financial planner, you know what he said? You can't do that. I said, well, I've already checked with CRA. Yes, I can. He goes, no. He says, it's illegal. I go, beg your pardon? He also told me I was going to lose my shirt.
Don't you know there's a real estate bubble? The prices are going to go down.
And you know what? All that meant was, please don't leave me as a client. You've invested so much money with me, and I'm not going to get all those fees and commissions anymore.
Yeah. So whether he didn't know what he was talking about, or whether he was dishonest, he wasn't giving you good advice, was he?
Exactly.
He really wasn't.
He wasn't.
He wasn't. And so, folks, just to not to put too fine a point on it, you can move money from your existing RRSP at a bank or some other institution. Has to be an existing RRSP into your Olympia RRSP. That's what Stuart meant about it. It has to go from one RRSP account to the other. So that's important.
And the other thing is, we find that there's a lot of people that have not taken advantage of tax-free savings accounts.
Mm-hmm.
Yes.
And if they haven't set up a tax-free savings account, they should really take a look at that, especially if they've got some cash sitting around that's not working for them right now. Putting it into a tax-free savings account at Olympia Trust will allow that to be lended out as a mortgage.
So now let's just talk about that. In the initial years of the tax-free savings account, the TFSA, I think we were allowed to put in, was it 5,000 or 3,500?
Yeah, it was around 5,000 when it first started.
Back in 2009.
2009. But now, you're starting to be real money. What are we up to now? 60 or 70,000 that you could have in there?
75,500 as of 2021.
Okay, so $75,500 that you could have in your TFSA. And I guess the important thing we should say here is, again, I know we've already said it, but TFSA is tax-free, folks, tax-free. That means if you put your money in a TFSA, $75,500, and lend it out at some reasonable interest rate, instead of getting taxed at the highest possible rate on interest income, there is no tax. So your TFSA can grow like crazy. So that's a very good place to put your money, and lend it from there.
Yeah. And the nice thing about the difference between tax-free savings accounts and RRSPs, beside the fact that when you take money out of your RRSP, you have to pay tax on it, whereas taking money out of your tax-free savings account, you don't. The other advantage is when you take money out of your RRSP, it's out. It's gone from your RRSP forever.
And you don't have that contribution room anymore.
Whereas with a tax-free savings account, if you take money out, you can put it back in the next calendar year. So let's say, for example, you need to grow some money for the next 3 or 4 years, but you've got a major expense coming up in 3 or 4 years. Grow it in your tax-free savings account. When it comes time, put it into cash, withdraw from the tax-free savings account. It's tax-free. Then when you get things reorganized, put the money back in the tax-free savings account and invest it to grow.
Yes. So that's the tax-free savings account is very flexible, and it's really fabulous for investors. So I want to go back to an earlier point where you were talking about helping folks who are just getting started with RRSP loans or TFSA loans. You're just getting started, and
what? Now we can't hear you. Can't hear you.
We lost your microphone. Oh no.
No, still can't hear you.
No, I'm sorry, Barry, we can't hear you. What I will say is that when we start talking with people, Denise has actually gotten very good at helping people understand the process and setting up the account at Olympia Trust, whether it be a tax-free savings account, whether it be an RRSP.
Lira, RIF, doesn't matter which kind of account. Oh, there, I think I just heard you.
Yes, yeah. I somehow muted myself, but now I'm unmuted. So, so it is a bit complicated when people are just starting out, and I see that in my law practice, because if we have someone who's just getting started as a person who wants to lend money from their registered plan, and another person who is just getting started wanting to borrow money from that person with a registered plan, we've got two people who have never ever done any borrowing or lending. And plus they have to work through, the rules that the trustee has. So as a lawyer, I do see that people find that to be quite complicated and daunting. So, I think my coaching to people who are listening is that you have to, like everything else, you have to learn the ropes, learn how it works. You have to find yourself a mentor, somebody who understands. Stuart and Denise obviously understand and can help sometimes. I'm not offering you up as coaches for everybody who wants to do one of these. I'm not doing that. But I just want to say that it can be tricky. I know Sean Impey out here helps lots of people with these loans. A good mortgage broker can help people work their way through. But there is a process, like everything else. None of us in the real estate investing space learned how to do rent-to-own or agreements for sale or RRSP lending on the first try at it. It takes a bit of time to figure it out. So having said that, let's move over to the why you felt so much more comfortable with perhaps the return and the security of RRSP loans when you got hammered so badly in stocks and mutual funds. You invested in those, you had professionals helping you. You didn't blindly go into it, I'm sure. I bet you spent time and effort trying to learn how it all went. Why, after being in both investing spheres, why do you find the registered plan, the RRSP sphere, why do you find that a better place to invest both for return and for security of investment?
Well, if you go back to when I mentioned that I started putting into RSPs when I was young, when I first started a job, and I know you said, oh, you probably looked into it, but you will probably find that a good majority of the population get caught in, this is tax season, this you've got to do, put your RSP in, put in mutual funds. And when you go in, and the one thing we found out, that these people that help you at the bank saying, okay, this is what you should be looking at and this and that, they're all salespeople. They sell the bank's products. They're not necessarily there to see what is best for you. They will do what is best for them. And plus, there will be somebody that says, okay, this year, this is the fund that we're going to sell more. And they're on quotas and stuff like that. And this is what they sell. So people are caught up in, well, I don't know what to do. I'm not sure. They tell me this is what I should do and I should do that. And then people blindly put money into stocks and mutual funds and then leave it there and think that because the advertisement says, hey, invest at 8 or 10%, for the rest of your life and look at all the money you're going to have. I mean, we've all been told that story. For those that are of retirement age, I'm talking about, maybe less now, but back then that's what they would tell us. And the money today just isn't there for those people that were retiring. And this is what we saw when we even got together. And like I said, looked at our finances, we've got to do something different. Now, just to give you an idea of what's happening, most people look at their returns and they go, and this truly happened to somebody that I know, came up to me and says, oh, Denise, are you still investing mortgages? Yes, she says. So I think I'm interested. She says, but I'm doing 14% on mine. I said, that's great. That's fantastic. My first question is it you or is it the fund? She says, I don't know. We got together for coffee the next day and we looked at her statement. And I remember when we were teaching at your group, and I used that same example, Barry, even back then, we looked at her statements and at the bottom, it said, yeah, 14%, that's what the fund did. Now, you know that they will get paid their commission, their fees before you even make a penny. Whether you make a penny or not does not matter. They get paid. At the bottom, it said her fund, one did 0.24%. The other one did, 0.66. Her account, 0.66. The other one was negative 0.24.
Ooh.
And she thought she was making 14%. Another example. This is why people don't necessarily know how to read their statement. And when I started looking at mine, I go, something's wrong here. Look, this is going down. It's not even going up. I had somebody else who said they had 60K they had invested, and they go, I funded 5%. Again, my immediate reaction was that the fund or was that you? She says, I don't know. I said, give me a call if you want. I said, I help people with this, but I said, just give me a call. I'll just help you with that. And then she did. She gave me a call and I said, okay. I said, so she had put in $60,000 in her RSP the year before. A year later, she had gotten her statement. And I said, okay, let's look at, you said 5%? I said, yes. And she had told me what she had in her account. I said, do you have a calculator? She says, yes. I said, put in 60,000 times 5%. She says, okay, should be 3K, right? 3,000. I said, how much money do you have in your account? She was livid. 60,200. That was less than a 0.1% that she made on her account. And she thought she was making 5%.
So when we decided that we were going to go into RRSP mortgages, it's because we had already taken training and we understood what real estate was about. And as we as real estate investors know, leverage is very important, which means we do a lot of work with OPM, other people's money. By going ahead and deciding to lend out our RRSPs, what we do is we take a look at the deals that are available where people are looking for money, and we take a look and say, does that deal make sense? Are we satisfied that the person that's borrowing our money knows how to use that money in order to turn a profit on the deal? Because Kevin O'Leary made the comment, and I loved it. He treats his money as little soldiers, and he sends them out to do battle. And at the end of the day, he wants all of his little soldiers to come home and bring friends. And so it's the same thing when we do an investment. We have people that will come to us and ask us if we would be willing to invest in their project. We'll take a look at whether it makes sense. And at the end of the day, I not only want them to be able to turn a profit on this and pay us back with interest in the time that they're expecting, but I actually want them to make lots of money as profit so that they're going to be interested. Because as we all know, sometimes in real estate investing, things go a little bit south and you may run into some problems that cost some more money. Well, I don't want somebody working at a razor's edge of a profit. I want them to have lots of profit so that if things start to go a little bit bad, there's still lots of profit. They're going to be interested in following through.
But the thing is, what has happened with us, because we first loaned ours out, before we ever even bought our very first property, we were looking at just growing our own retirement. So that applies to everybody out there who eventually will retire and wants to have retirement income. And what we found with real estate, it was very much a predictable return. And what I liked is that it was a true return. So let's say somebody is borrowing like my RSPs and they're going to pay me 8% on it. I will actually, at the end of the year, I will have 8%. Not like this woman that thought she was getting 5, but got less than a negligible amount. So I get a full 8% because all the other fees are paid by the borrower. And the money is there, it's available. There's always real estate investors. And again, you have to learn and trust, people to be able to invest with them, but it's predictable. And we work with people that we know. And that's the whole thing, because there's rules around, doing the mortgages, but we work with people we know. We know their reputation. We know the type of work that they do. They're being, maybe coached by somebody we know very well. So you kind of know what they're doing. Just because somebody comes and asks us to borrow my money doesn't mean we'll say yes.
Okay,
so can't do that.
No, you can't do that. So the part I want to talk a little bit more about is you said when we lend our money, we have a predictable return. So that's a predictable return as long as everything goes the way it's supposed to go. Stuart, you said you analyze and look to see whether you think it's you think it's a good project. And when you said project, I was immediately thinking that you're lending to someone who is doing a fix and flip, say. Maybe they need renovation money.
Well, and part of that is the fact that RRSP funds can be, it's a good source of private lending for a person that needs to borrow the funds, but it is expensive money. So if I was doing a buy, rent, renovate, and refinance, the key word on that as far as this strategy goes is the refinance. I've got to make sure that I have loaned my money to someone who has a solid exit strategy, which means that usually the mortgage is for a relatively short term, maybe 1 year, maybe 2 years at most.
But there's different strategies.
Now, what about a more basic loan for somebody who's just starting out? They just want to make a basic mortgage loan to somebody. They're not doing any kind of renovating. It's a buy and hold investor. Let's say that they've owned a property for a while. They want to get some of their equity out. They've got an existing first mortgage. They want you to lend some money on an RRSP second mortgage. So there's a bank ahead of you. What would you do in a case like that to make sure that you feel comfortable that you're always going to get paid back, even if there's a foreclosure and there's trouble? The bank who has the first mortgage is going to get paid before you. If you're in second place, how do you work the ratios so that you're comfortable that if things go south, as Stuart said, they sometimes do, how do you make sure you're going to get paid?
Well, the thing is, usually on a second mortgage, you still want to have the person have equity in the property when they're dealing with a second mortgage. In case the property goes down a little bit, I mean, we know that over time, land properties go up. But there's the odd time where there is a little dip. So it all depends where you are right on the market at the time where you either sell or you need to buy or whatever. That happens no matter where. But over time, we know that it increases. But when we're working on a second mortgage, then it is usually a smaller amount, for a second mortgage, because you still have your full mortgage in there. So the amount of equity that you've had in there is there. And then you're probably loaning. Could be, it all depends on the project, but it could be an 85 loan to value, which means 85% is loan, bank, and the second mortgage, and yet there's still 15% there. That is that buffer if something happens, that you're not, if the property goes down a little bit or something like that, then you're kind of covered. So you kind of look at stuff, like that. But the one thing, whenever anybody asks us for money, and I work with them with that, I insist on an investor package. And what that is just everything is detailed as to what they want to borrow. First of all, who's borrowing? Who's on title of that property? What do they want? What are they willing to pay for an interest? What are they going to use it for? How are they going to pay it back? So all of that needs to be detailed, because if they can put it down in writing where it makes sense, that means they've had to think it through and understand what they're doing. We get sometimes requests and I'm going, there's no way I would put my money in that project. It just doesn't make sense. And we're both strong in the due diligence area where you want to analyze that deal. But the deal itself, you just want to make sure you're going to make your money back. And you have to basically know and trust the person that is going to borrow your money, that you feel and understand that they will pay you back because they've got a good plan in place. So we talk that out, and I get them to put it down in writing before we even look at it.
Yeah, that is so important. It's trust but verify. Diligence is important in every aspect of real estate, and it's no different when you're being a lender. Absolutely. Or when you want to be a borrower in the registered fund space. So to go back to your example, Denise, somebody comes to you for a second, you take a look at it. The first mortgage is 70% of the value of the property. They want to borrow another 15%. So the 70% on the first, the 15% on the second. Now we're 85% loan to value ratio. And that means they still have 15% equity in the property, and that is your cushion to protect against things going bad. Is that how you think about it?
Yes.
And the other thing is that we want to take a look at the market where the property is located to make sure that we're not seeing a potential of a decrease. We wouldn't want, if this is a town where the major industry has already announced that it's going to be closing down in 2 years, I don't want to be putting a second mortgage on a property in that town. So it's important to understand all of the economics. It's the thing that we have, as real estate investors, have learned. It's important as we're planning where we're making our investment. Well, it's the same thing when you're lending money on a private deal. make sure that you understand what the deal is and how the money is going to come back.
Yeah. That's the professionals call that underwriting the loan. And so that's what you're doing. You're underwriting the loan, not only from the perspective of the person who's borrowing, their background, what they're doing, what they know, did they really understand what they're doing, and is there a good reason to need the money, but also the wider macroeconomic picture, the economic fundamentals of the area in which they are lending. So you're quite right. It does depend a lot on the market, doesn't it? In Ontario, in the Golden Horseshoe, and in the Lower Mainland in British Columbia, properties have been increasing in value quite nicely and by quite large percentages. So you feel a little more comfortable there. It's bigger populations. Here in Alberta, we're flat to negative. So if you're lending in Alberta, you'd want more of a buffer to cover you for what we don't know is coming. Alberta is got lots going on that we don't like. So you'd have to be more careful in Alberta. In Manitoba, you'd go good old steady Eddie Manitoba. They're just, no matter what, they plunk along and they go up a little bit. They never seem to go down. So, those are three totally different markets that require different underwriting. And it's not just provincial, is it? There are places in Ontario that aren't rocketing along like it is in the Toronto and Golden Horseshoe area. I mean, you'd have to be careful. Where would you have to be careful in Ontario? Where is it not booming? Just as an example.
Well, I know right now, some of the areas in Ontario that depend very heavily on tourism are suffering like crazy because of COVID.
Right.
And it's going to take a long time. If you've got an area that, like the Muskokas, north of Toronto, it will come back. But the question is, how long is it going to take for that to come back, especially if you've got a large tourism presence and a lot of the employment in that area is based on tourism? It'll wait until the COVID restrictions are lifted and then people start to travel again. Northern Ontario, there are some mining towns up there where the mining is good, but there's some other areas where the mining is starting to close down. They're already planning shutdowns. Yeah. So you've got to watch out and know exactly what's going on in the area where you're looking. Do the research.
All right. Now there are a ton of questions that people are asking, and we three could just carry on like this for the next hour or two, just batting things back and forth. But let's get on to some questions. Wayne is popping them up for us. Robin says, can you do a mortgage that is not using registered funds?
Oh, absolutely. Cash is good no matter where. What I love about doing any private mortgages, you can do it with all cash if you wanted to. Just remember, though, any interest that you make from it, you'll have to declare that and pay tax on it. And that's why when we use registered funds, that is tax deferred. So you don't have to worry about taxes right now. And then TFSA, it grows tax free. So you got your three scenarios. But what I like about a private mortgage is we will occasionally have more than one person on the mortgage, because not everybody will have the full amount required, especially if you're doing a purchase and you're doing a first mortgage, which would be a larger amount than a second mortgage, right? Which is just a small portion of the equity. So when you do a first mortgage, you could have, and we've done that, somebody has cash, the other one has TFSA, and the other one has RRSPs. And it's only one mortgage. The rules apply to everybody, the same rules, but it's only one mortgage, 3 people on it, and their portion, let's say it's $300,000 and each one has $100,000, just for quick math. It just means that their portion, they get a third of the interest is theirs, period. So they're apportioned for the amount of money they have in the mortgage, they're apportioned that, and they get the full interest rate on that. And again, true rate of return, the fees are paid by the borrower. That means legal fees and administrative fees for the trustee. So again, normally you need 2 lawyers, so like Barry, so we would be paying Barry's fee and we'd be paying our lawyer's fee if we were doing a mortgage and using those 2 lawyers. So we as the borrower would be responsible.
So yeah, you can lend money other than through an RRSP. Ali says, hey guys, how does this work with the Smith maneuver?
Well, most of what we're talking about is registered funds, which mean that they're either tax-free or they're tax deferred. The Smith maneuver is perfect for dealing with tax expense, taking your non-tax expense mortgage and making it a legitimate tax expense on your income tax. So what we're talking about is apples and oranges here. It's two different things.
Yeah, Smith maneuver doesn't really enter into what we're talking about today.
That's right.
Tim says, is the RRSP loan secured? Now, Tim, that's a really good question. And the answer is?
Absolutely.
Yes.
Now, something to keep in mind. It has to be secured on Canadian real estate. Doesn't matter whether it's residential, commercial,
Industrial or raw land.
it doesn't matter as long as it's Canadian real estate. So if you've got somebody that wants to borrow some money and they've got property in the US, sorry, you can't use RRSPs.
But it must be that loan is secured on a mortgage and the mortgage is done by a lawyer like Barry. We have to deal with lawyers.
Got to deal with lawyers. So that's a good question from Tim. So in Denise's example, the $300,000 loan that might have had three different folks with three different ways of putting their money in, that $300,000 is wrapped up in a proper land mortgage. The land mortgage is registered against the title, prepared by a lawyer and registered against the title. And then if the borrower does not pay, as the lender with a mortgage as security, you can foreclose on them. So that, Tim, that's how you're secured. All right. What does Kim say? Does a TFSA have to be with Olympia Trust or another trustee, not a bank, to be loaned as a mortgage?
It must be, the registered funds must be with the trustee that will allow arm's length mortgages. And we didn't get into arm's length as opposed to non-arm's length mortgage, but just quickly is some of the banks will allow you to do a mortgage and will allow you to borrow your own money, but it has to be on your own private property. You can't use it for a rental. The rules are different. The fees are different. You must have CMHC insurance. So that's when we call non-arm's length. So for us, we always deal with non-arm's length, which means you have no relationship with the person you're borrowing from. So it's not family, it's not anybody from adoption, it's not anybody from marriage. And also if it was a corporation, that you don't have any interest in that corporation either. So that's why we say totally arm's length. We can't borrow each other's RSP, Stuart and I, because we're married. So that is outside of the rules. So it's got to be other people that you deal with. And yes, that TFSA can be with a trustee that will allow mortgages. And Barry mentioned we mentioned the four big ones like across Canada that will actually do that.
So, by just to flesh that out a little bit, my main banking is with TD Canada Trust. Canada Trust is a trustee, but they don't want to do these mortgages. So you can't go off the TD Canada Trust and do it. You got to go with Olympia, CWT, B2B, or Community. Right. Those are really the four.
Yeah.
Next question: if your account is with Olympia, how do you top up your RRSP or TFSA? Do you just transfer funds over to it?
It's actually funny because we're in the middle of lending money on a mortgage right now. And so with January 1st passing, I was allowed to put an additional $6,000 into my tax-free savings account. So when it came to my share of the mortgage, as Denise was organizing things and playing Tetris to make sure she got all the right amounts of money in there, our plan was for me to have the $6,000 more than was currently, currently in my account. Yesterday, the trustee sent a message back saying, there's not enough money in the account. What are you going to do? Well, I hopped online and did an online transfer from my bank into Olympia Trust so that this morning there's enough money in there. So yeah, topping up your RRSP and TFSA is actually quite simple as long as you've got the contribution room.
Yeah. So when you have an Olympia Trust account, it's easy to go into your Olympia Trust portal and you just go in, it's just called online transactions, and it says, move my money. And it's like doing like an e-transfer like you do with a regular bank. You're able to do that. So Stuart was able to go from Olympia Trust to say, okay, move my money from this bank into my Olympia Trust account, my TFSA account. So he topped up to $6,000. He had the amount that he needed in his account. Whereas with an RSP, you can do the same thing, but then Olympia will actually send, again, that transfer. So it's not just going to be an e-transfer, but they'll work out the transfer with your, with wherever you're getting the funds. I mean, if it's just cash going in, there's a way to do that, and you'll have to show that you have the contribution room. which if you're working, you have a little bit of contribution room on a yearly basis.
So the answer to that is yes, you can do that.
Easily.
Easily. Next question. Is there any minimum set interest to be paid to the account every year?
Yes, there is. If you have a private mortgage that is going to go longer than 1 year, which some of them do.
Yes.
The Olympia Trust rules. Now, it may be different for some of the other trustees, but the Olympia Trust rules, if your mortgage goes longer than 12 months, you must pay a minimum, or you must get a minimum of one interest payment in your account. So you work that out with the borrower of your fees. So you work that out as to exactly how that's going to work out. I mean, we're not going to go into the details here, but yes, there must be a minimum payment. Sometimes what we've done is, let's say if the mortgage is 18 months, well, we'll pay maybe half the interest at 12 months, and then we'll do a balloon payment. So whatever interest did not get paid, plus all of it, the principal and all of the interest that did not get paid at the end. So different ways to work it out.
They're quite flexible. As long as you pay the minimum, there's other ways you can defer and maneuver other payments. But yes, you have to pay a minimum, so you have to consult whichever trustee you're using to find out what that minimum is as you negotiate your loan.
Mm-hmm.
Karen says, how do you choose the deals that you invest your RRSPs in? Do you have specific types of deals that you focus on? Oh, everybody has something like. What do you guys like?
I'll tell you what we don't do.
Okay.
For one thing, we don't do debt consolidation. If somebody says, you know what, I'm in debt here, but if I put in a second mortgage on my property, I'll be able to get that, pay off my debts. And I'm thinking, okay, it's my money you're playing with now. And if you had trouble managing your own money, I don't want to be part of that. I know there are circumstances for everybody, but it's just something we do not do. We do no debt consolidation. We actually work. Sorry, I said we work within.
So that's out. Debt consolidation is out, but
we work within a tight niche in the sense that we work with investors that we know, that we like, that we trust that they're going to pay us back. That is super, super important. But we'll do first mortgages. We'll do second mortgages. We've actually done some third mortgages, which scares people, but there's nothing scary about it if there's lots of equity. And that's the thing here, lots of equity, right? But we do those. So we've done flips, like we've invested in flips or borrowed on flips, and we've done flips. We've done the buy, rent, and hold, just buy a property, and rent it out. We've done the BRRRR, which is the buy, renovate, rent, refinance, and then repeat. So the BRRRR strategies, we've done that too. We've done single family homes, we've done condos, we've done, rent to owns is another one that we've done. Those would usually be on a second mortgage that we do a rent to own. We've done multifamily, like we've done so many different types of mortgages. So
the key thing is the deal has to make sense.
You want to get your money back. That's the bottom line.
And as part of that, and as you're starting out, I mean, I think we can analogize this a little bit to our real estate investing careers, where I'm pretty sure that almost all people, when they start out and think they want to invest in real estate, they do a buy and hold. They buy a property, they rent it, it's long term. They don't start out purchasing a property by way of an agreement for sale, joint venture it with someone because they need to do some renovations, and then exit through a rent to own. I mean, most people don't start out like that. So if you're thinking about RRSP loans and where you would start with something simple. Start with something where there's a property that's easy to analyze. Start where there's a decent amount of equity, where you, as a person who don't really know how to be a lender, are kind of learning your trade. Give yourself a big buffer so that you don't make a mistake in your first one or two deals. And then you can be like Stuart and Denise and do third mortgages and BRRRRs and flips and reverse those. Takes a while to get to that. So don't be too precipitous.
But I remember, Barry, the very first time that I borrowed. I know I lent my money out when I got the severance pay. And that was my severance pay. I hadn't looked at my other RSP funds at that point, right? This was just something I was going to try out. And I understand what it's like the first time you kind of loan your money out to somebody. Yes, and I understand it because I've been there, and I was explaining that to somebody yesterday. I said, I understand. I fully understand. Somebody may have, I don't know, $200,000, $300,000. They'll tell you they've got 50. And that's okay, because they want to try it first, see how it's going to work, get comfortable with it, and they go, oh, well, that wasn't too bad. You know, I learned a lot along the way. And then they go, next time they go, oh, yeah, well, I can invest more now. And that's fine too. But I know what I was like the very first time I had to loan money. I was scared. Totally scared.
Totally scary. Ilona says, how do people with projects find someone like you to invest with? How do people with projects find people with money?
I mean, this is all just basic raising capital as an investor with the project. If you've taken the training on how to raise capital, what you're doing is you're raising capital. The difference here is you have to understand what registered funds can do, because that will broaden the scope of people who might have funds that can lend to you. You have to be able to explain to the people that you know and have a relationship with how they can invest their money in mortgages and have it grow better than the returns they're getting in the stock market. Or the other thing you can do is attend events like this, go to real estate meetings and meet the people who are actually doing this lending and develop a relationship with them. And I keep referring to this develop a relationship because those of us that understand raising capital, the security commissions in the various provinces have rules about who you can ask for money and who you can raise money from. And one of the biggest things is you have to have a relationship with the person that you're borrowing from or that you're lending to. So you can't just walk up to somebody on the street and say, hey, I can give you good money in your RSP. How's about lending me your money? You know, that's totally illegal. So there are some rules around this. There are some processes. But there are lots of people that have RSPs available. There's lots of people that are doing the same lending that we are. And there's lots of people that would do this lending if they understood it.
Now, the one caution, maybe, Barry, that we could just mention is people can't just go online and saying, I'm looking for this amount of money and I'll pay this amount of interest and all of this stuff. You can't be advertising this. Yes, I know some of the investors have, but there's so many different rules where people can get in big hawk with that. And just think of it, even mortgage brokers today. I mean, how many mortgage agents and brokers are out there? You don't see them online advertising all this money. We're going to pay you this amount of percent. It's because there was rules there and they're abiding by the rules. Unfortunately, some people don't.
So you just mentioned something important, Denise. Mortgage brokers are people to talk to. If you want to find somebody who has money, you can talk to a mortgage broker. That's their job. One of their jobs is to gather in a network of people who have money and who would like to lend it out. And that could be private money, it could be RSP money, it could be TFSA money. Mortgage brokers know. Going back to your example, Denise, when you were at the investor meeting and you said to 8 people, I've got money to lend, who wants it? You could have done the reverse of that. You could have said, I have this project and I need money, who has some? And chances are one of those 8 would have said, oh, I have money to lend. So you can ask, and you have to get out and show the flag. Don't. Education, you go to meetings, you establish relationships, you get yourself in this game, and over time you develop a presence, just like you folks have, because you've been at it 10 plus years now. And I think that you have a pretty broad network. You have connections on both sides of the lending and borrowing. You help people, you lend to people, and I'm pretty sure that you probably don't have very much trouble if you need money locating money, or on the other hand, you probably are approached a fair bit to lend money. But that's what's happened after doing this for 10 years. I mean, do you have any difficulty finding or lending at this point in your careers?
No, we don't. And to tell you the honest truth, the first time that I actually went to a friend and we had a project and I wanted to borrow money, and I still remember his name was Alan. I said, I just went to Alan. I hadn't seen him for a few months. He was a good friend, but it's just so we didn't see each other all the time. And he was somebody that we saw regularly at church, but he had moved and he was going to a different church now. And I said, hey, Alan, I said, are you happy with the returns on your RSPs? And he said, heck no. I said, would you like to make more than what you've been getting? He goes, yeah. And that was easy. But he was a very close friend of mine. Now, if you go and say that to somebody, a stranger, like, this is not going to work at all. The key thing here is build relationships. That's what we've been doing for 11 years now, is build relationships, network with people, get to know them. It's like a marriage. You're not going to go up to somebody right away and saying, hey, I want to marry you. Hey, you want to talk to them first. Maybe eventually you'll ask for a date. Maybe eventually they'll become your spouse. Who knows? But that's not where you start.
No, you build relationships, you build community, and it all generates. Now, Doug Robertson throws in a question here. Why would someone loan money by mortgage not want a monthly payment? And Doug wants monthly payments.
The simple answer to that is it depends on where you are in life and what you need to do with your savings.
And what the funds are.
Because if you're 45 years old and you're trying to grow your RRSP, chances are you're not going to be withdrawing from your RRSP in the next 10 years. If you've loaned, let's say, $50,000 at 8%, that's a $4,000 annual interest earning. Divided by 12 months, that's about $350 a month. Well, if you had $350 a month coming back into your RRSP account, what are you going to do with it?
Because you can't do anything with it.
You really can't invest it. It's too small an amount. Whereas somebody who's doing a project where they're renovating and they have no revenue coming in could use that in order to manage their cash flow. So as a lender, you might be able to negotiate, maybe they were willing to pay 6% or 7%, but you can say, hey, I'm willing to balloon all the payments so you don't have to make monthly interest or principal payments. Will you pay me 8%?
Now, it may be different if people have, let's say, a line of credit on a house and they want to use that equity and loan that money out, which is possible, but then they have interest to be paid on a monthly basis. So that cash, yes, you'd be looking for monthly payments. But when we're talking with registered fund, the amount going into the account is small and it sits there doing nothing. Olympia Trust is not going to pay, or any of the trustees don't pay interest on that money while it sits in the account. So one of the things that we've done from the time we've started is be able to help investors. So one of the ways when we loan our money out, and people say, oh, you'll do that? Yes. So we loan it out. I said, listen, balloon it at the end. Like somebody wants 12 months. And I said, okay, 12 months, just pay me at 12 months. And one of the things that we do, Barry, also, maybe not everybody does, but that what we do, and this came from a particular project, and you'll understand why when I mention this. We were loaning money to investors in Toronto, and those investors did high-end flips, is what they did. We loaned money to them. When they came and asked us, said, could we borrow money for 9 months? My first question was, have you ever done a project where it didn't quite go the way you wanted to, and it took a little longer? They go, yeah. I said, I'm not going to do 9 months. And they thought, oh, like they were all sad. And I said, I'll do 12. They go, what? I said, I'll do 12 months. I said, there's no prepayment penalty. Just pay me once the project is done. At least when the project, if you're not done at 9 months, if you are, that's great. But if you're not done, I'm removing that stress for you right now. You don't have to worry. What's going to happen right now to this property because I can't pay out the mortgage? Do I have to go get another mortgage? I don't have the money right now. What do I do? Let's remove the stress. And guess what? In that particular instance, they paid us out after 10 months. And all they could say was, thank you, thank you, thank you.
So the short answer to Doug's question is it depends on circumstances. Different people have different needs and do different things, as is the case with all investing scenarios. So
exactly.
Next, Anna says, can I transfer my RRSP from banks to Olympia Trust without a borrower yet? Oh, so you don't have, I think Anna means she doesn't have anybody to lend to yet, but she's looking to be ready. So can she do that?
Absolutely. And we actually suggest that to people because like right now being seasoned investors, may be different from somebody starting out, but as seasoned investors, what happens is that when we get a deal, we move fast on it. So if the money is ready, then we can actually go borrow it.
Yeah.
So it's always great that it's there, sitting there, because if we have a deal and you say, I have money, but now I have to move it, it takes anywhere, Olympia Trust will tell you 10 days to 6 weeks to move your money from your existing financial institution to Olympia Trust. Now, I've seen as short as 36 hours, and I've seen as long as 3 months. So if you've got a deal going, we can't wait for you. That's all.
So get it over there and be ready. If you're gonna operate in this space, get your account open at Olympia. Start working on moving your money from wherever else you have it, and be ready, because people do want speed. Mesa says, what is a good return to expect in an RRSP mortgage, inclusive of fees, if you're in first position versus second position? Oh, that's a good question. Differences in rates depending on what position.
Yeah, well, when you say inclusive of fees, you get a true rate of return. So there's no fees for you as an investor of loaning your money. There's no fees to be paid. So when you loan your money, you get that plus the rate of interest fully, and the administrative fees come back to you also. So we've seen from a first mortgage anywhere from usually 6 to 10. Now, 10 is almost unlikely, but we've seen it. There are some people that will do it 6. We've seen more typical to be 8% is what we've seen mostly. But then from a second mortgage, you usually see from 10 until, I've seen up to 18. But you know what? We've been in this space for a while, and I tell people, if you have, as an investor who's borrowing money, if you have to pay, the 12, 14, 16% plus points, which is more on top, I said, go elsewhere. There is so much registered funds out there. There's no reason as an investor that you should be paying these high fees.
That's a good point. There's lots and lots and lots of registered fund money sitting around just waiting for people. They're really waiting to be educated that they could actually lend their money, and you can get a much better interest rate because they'd be so happy to make some money as opposed to no money that they definitely would lend to you at less than 18% for sure. Next, does Olympia Trust charge fees to operate, hold an account with them?
Yes, they do. The cost to open an account, any registered account with them, which is a self-directed account, right now is $150 plus HST, and it's paid on January 1st, and it's for the full year. If, let's say, you're in the summertime and you're less than 6 months, then it's half the amount, which would be $75 if you open an account late. And then December, if you open an account in December, well, they waive the fee because January 1st is the new fee. So yes, there is, and that you do not get paid back. That is your responsibility as a holder of an account at Olympia Trust. So like for Stuart and I, we each have an RSP and a TFSA account. So I pay $150 plus GST, HST for my TFSA. I pay that also for my RSP, and then Stuart pays that for his 2 accounts also. But
it's a once a year, correct?
Once a year, yeah. January 1st, you either get it through a bank withdrawal or credit card. You work that out with Olympia Trust. When it comes time for the mortgage, though, there are fees right there that are associated with the mortgage that you get paid back. So when I say paid back, there's the mortgage setup fee, which is there's a $150 plus tax, which is the mortgage setup fee, and you can have that as part of the mortgage right away, prepaid, so you don't have to worry about that. There's a monthly fee charged to your account. Depending on the province, will be different. In Ontario, it's $15 plus HST, and then there's a discharge fee at the end. But all of that gets paid back by the borrower. So for us, what we do, some people will leave some money in the account, and when we talk to people, we explain all of that. They either leave a little bit in the account to cover those fees that they're going to get returned, or for us, we put in our credit card, because we pay our credit cards every month. So I don't mind paying that bit every month, and then it still comes back at the end, back in my account.
So as a lender, you really only have those yearly account maintenance fees. Everything else in the end gets paid by your borrower.
Exactly.
What it amounts to. Ali says, is there a minimum amount to lend?
I should say no, but individually, it doesn't make sense for an investor to borrow a very small amount just because of the cost of it. I've had somebody saying, oh, I'm willing to lend my friend, he's doing a property and I'm going to loan him $10,000. And I'm going, do you realize what the fees are, the legal fees from the lawyer, the borrower lender, and the fees for the lender lawyer and all the other fees? And I said, that's going to be expensive for you. It doesn't make sense.
Yeah.
He goes, oh, so a lot of people won't even look at you if you don't have 100K. We haven't done that. We've done this from, like I said, for so many years, and we like to help as many people as we can. It doesn't make sense a lot of times to look at less than $25,000. But then again, that 25,000 or 20,000 may make sense if you've got a mortgage and you have that little bit missing to make the amount you need.
Yeah. I mean, I do believe 25 would be the absolute minimum. I kind of have in my mind that with all of the, if you're borrowing with the fact that you as borrower are paying two lawyers and have other costs to pay, it would have to be a really special circumstance where what they'd have left out of 25,000 was just so important to them. I'm kind of up around the $40,000 to $50,000 number, but that is an individual choice. You have to look at it as a borrower. You have to look and see what your costs are, and so that's that one. Ilona says, Ilona, you are a girl with a lot of questions. I like that. What kind of due diligence do you do on investors, and what type of screening questions do you ask? Well, Denise and Stuart do lots of diligence, but
yeah, the investor. What, did you want to tackle that one? Or?
Well, I mean, one of the things that we've developed over time that we ask of anybody who's borrowing money from us is to complete an investor package that tells the complete story of who's borrowing the money, how they're going to use the money, and most importantly, how and when are they going to pay it back. The big thing is that we don't loan to strangers. We loan to people that we understand, that we know, that we've built a relationship with. Mm-hmm. And that's the same thing for anybody that's doing this type of private lending. So the screening questions that you would ask are the same sort of screening questions you would ask somebody that you're going to be a joint venture with, somebody that you're working with on a project. We want to know all the details of the project so that we can assess whether this is a good deal or a bad deal.
So the project becomes more important as the person that you feel confident they're going to pay you back. But when you're looking at that person, you usually have a relationship with them already before you loan to them. So to get a stranger out of the blue asking me for money, I would not lend. I mean, I just wouldn't. It's as simple as that. I don't know who they are. I don't know their reputation. I don't know, I don't know their ethics. I know nothing about them, so I would not lend. So first of all, you need to build those relationships, get to know people, get around them, get to know them and know of them. So that's important. But you can also ask for a credit report from the person that is borrowing. That you can ask. Do you know that I've been asked once in 11 years?
Really? Wow.
That's it. Once.
Wow, once. So folks, we've run a bit over our projected 1 hour. We do have 2 or 3 more questions. Do you have room in your schedule for 2 or 3 more?
We could do that.
Sure.
Okay. All right. Well, we'll carry on and just go back to Ilona for a little bit. So lending or borrowing through registered funds is, like we said, it's like anything else. It takes a while to get good at it. And, Stuart and Denise have a package and they invest with people they know. There is training that you can do to learn more about RRSP loans. And in fact, Donna says, thank you, Donna. Donna says, in fact, we're going to be doing some of that in future events. But there's a lot. There's checklists. There's ways to analyze. There's quite a bit to it when you're doing other than Stuart and Denise, which is lending to people they know. So more will be coming on that later. Now, where's our next question? Because Ilona, that's all you're getting on that one. Harry says, is the interest simple interest or compounding interest? Another great question.
It depends. It's
simple.
What you negotiate.
It's simple.
Generally, what we do is we do simple interest because most of our loans are a year or less, and it's easier to do the calculation.
Plus, you're private investors. You're not a big mortgage broker here or anything like that. So it's usually simple interest that we do. I don't know if you come across a lot of compounding interest, Barry, in your private mortgages.
No, they're very often shorter term and simple interest, and part of it is just because of the ease of calculation. Everybody understands it right away. You don't have to prepare amortization schedules. You don't have to go to an accountant to say, okay, how do we figure this out? So you can do whatever you want. It's a negotiable thing, but I do see simple interest more often.
Yeah.
Now, what happens if you invest in RRSP mortgage through Olympia with a corporation and you're in first position, but that corporation goes bankrupt?
Well, hopefully you've done the due diligence and made sure that your value of the property is well protected. Now, the challenge when a corporation goes bankrupt is that there are some other priority people that come into place even before you as a mortgage holder.
Barry can attest to that.
So, I mean, if that corporation has failed to do payroll, if that corporation has failed to file their GST, HST returns, if they failed to file their source deductions, then the big bad Canada Revenue Agency gets first in line to get access to any money that's coming from it. So, I mean, there is always a risk, whether you're loaning to a person or to a corporation, but the key thing is do your due diligence in order to minimize that risk.
Yeah. When a corporation goes bankrupt, if you have a mortgage, that property doesn't just get thrown into the bankruptcy pot because you have a mortgage as security. What Stuart is saying is that that CRA can get at the GST and the source deductions, but overall, as a broader look at it, you maintain a secured position and you just don't get tossed into the bankruptcy pot. But you still have to focus on whether this corporation is actually operating properly, and you'd be doing that at the beginning. That's a little harder to do, to find those things out, but you should do it. Next question. Do we have any more? Couple more. I'm sure they're popping up here momentarily. Wayne is juggling questions as we speak. He's going, here we go. Wendy, do you participate in the TFSA Maximizer plan and split the interest with an RRSP? Well, Wendy, you're talking stuff I don't really know about here.
Well,
hopefully
we weren't going to touch on that, Barry.
We've seen this strategy being promoted a lot. Now, you remember I did the disclosure earlier that I spent 5 years working for the Canada Revenue Agency?
Yes.
I've got a little bit of an insight into the way that they think. One of the things that you will find if you do your research on CRA is that any money that is earned as a result of a registered fund is expected to be paid back to that registered fund. So let's say, for example, you decide to loan your RRSP as a mortgage, and you've heard that as a private lender, you can ask for points. You certainly can. But that cash you get as points has to be paid into the RRSP. You can't take it in your pocket. Similarly, this TFSA Maximizer that I've heard people talk about scares the pants off me. Because as I understand it, basically what's happening is that they're getting an increased rate of return into their tax-free savings account based on the fact that they're also loaning some RRSP money. And when CRA comes along and finds out that you've played this game, CRA may decide to come down on you with the silver hammer. And the big thing is, you don't want to get on the bad side of CRA when it comes to registered funds, because one of the nasty things that they can do is deregister the fund back to the time of the loan. So if you did this 3 years ago, and this was going forward and you thought that life was good, and then the person that you loaned the money to gets audited by CRA, and CRA sees this funny loan in their books and decides to chase it back and discovers what you did and decides to deregister your account from 3 years ago. Not only do you owe all of the income tax on the entire deregistered account, because they deregister the whole thing and make it all taxable. You owe the income tax, you owe the penalty, you owe the interest, and any money that was used for over the 3 years, you owe all the tax on penalty on that as well. So it's just not worth it to play games. The rules are there, the rules are easy to follow, and that's why I don't like the TFSA Maximizer.
Yeah, you got to be careful of those kinds of things. Sooner or later, they all come a cropper with the CRA. Sometimes it takes a while, but the the wheels will grind you down, and yeah, that would be nasty, wouldn't it? To have a deregistration, pay all the tax, pay the interest, pay the penalties, and pay the tax on the money you made. Anyway, be
when
careful.
I get people that say, "Oh, well, it's a gray area," I said, "No. CRA is pretty well black and white. There's no gray there."
Yeah, and it's just not worth playing those games. Even if you think, you might have an argument, it's just not worth it. All right, folks, that is all the questions we have for tonight. So, and all the time we have.
So there's questions, but we don't have.
My boss, my producer Donna, tells me that there are actually more questions, but we now have run out of time. So I want to thank Stuart and Denise for showing up and doing the fabulous job that they always do. You guys are a fountain of information. I can just tell that you love doing this, that this has really been a charm for you over this last 10 years. First, you found each other, dumped those other people who didn't appreciate you, and now you're doing this, which you obviously love. So thanks for coming on. And as we go through and do more things in my creative real estate education series, I know we're going to have you back, because we've really just scratched the surface of this, haven't we?
Absolutely.
Yeah, we have
so much more to talk about.
Yeah, thank you so much for having us. And you're right, it's a topic we love to talk about. So
yeah,
that's great.
All right. Well, thanks again. Have a great rest of the evening, everybody who listened. Thanks for attending. And we'll be back again next week, and we'll bring Stuart and Denise back for another session at another time. Thanks, everyone, and good night.